Hi all, welcome to Free Float. I am Sham and I have Kishan with me.
Hi, Sham.
Today we'll be discussing a very popular strategy and our little twist to that strategy. It is called dual momentum and it's also called Global Equities Momentum. It is a very simple strategy. At any given point in time, you're long only one ETF, and it's a concept that we love here at Free Float because it takes away the implementation complexity out of the picture. So anybody can just log in once a month and just trade this ETF. It's a very simple thing to follow along, and its popularity is probably explained by its simplicity. And the thing about it is the inputs are also very simple. So you just have your S&P 500 index returns over the last 12 months. Then you have your world ex-US, which is basically developed market equity returns over the last 12 months. And then you have your US bond returns over the last 12 months. Now, depending on which one of these assets have outperformed, you end up buying that ETF at the end of the flow. The details are described in the in our Substack newsletter, and it also has links to its most recent performance and also to some of the back tests that we have done. So do have a look. And apart from that, here comes the twist, right? So in this whole scheme of things, you're only looking at developed markets and you're looking at plain vanilla ETFs. So what happens is, let's say, I want to be long US, right? Is S&P 500 the only way to be long US? Probably not, right? When Gary sort of came out with his paper on dual momentum and how and how we tested out the strategy, there were no momentum ETFs listed. So what we have done is we've taken the same input, which is S&P 500 and developed markets and bonds, and said that, okay, if you're going to be long equities in the US, be long the MTUM ETF. MTUM is the momentum ETF for the US. And if you're going to be long DM equity, then you can be long the IMTM, which is the International Momentum ETF. Both are from iShares. So the advantage here is you're going to be long equities anyways. So why not, add some fuel to the fire, right? So just go with the momentum version of the same thing. And both MTUM and IMTM are long, predominantly large caps. So you're not losing, you're not really twisting the original research by much. So Kishan, do you have anything to add to this before we go to the second twist we've done with this?
Okay, yeah. So like like you said, right? I think I've read this book like a few years ago, Dual Momentum, but I'm by Gary, and so I was struck by the simplicity of it. That every month you just check whether whether the S&P 500 is above this and stuff, or you check the world MSCI and you check whether it's up above the bond rate, and you invest. If they're both not above, then you just hold it in a bond fund. I found that to be like a very easy to do, like implementable strategy, and obviously, that got me thoughts that whether you can really replicate this in like other markets and stuff, and I dwell deeper for the same reason, like what attracted you, I guess. Like I think most people want to look for something like this because it's easily implementable, and even as a investment advisor, like if you're in the business of investing, you want something like this because it's easier you to communicate this to other people, that that it's an easy strategy for anyone to understand, and it makes your implementation and makes all those things easier.
Absolutely. So the other thing is, it has worked fairly well in the forward test, so to speak, like even after the book came out. So what you typically see is the minute the paper is written, the alpha goes away. But that didn't quite happen to this strategy. But at the same time, whenever you look at slow moving strategies that rebalance monthly or quarterly, you need to have at least like a 5 to 7 year window before you can draw any conclusions of it. So even if it is outperforming or if it is underperforming, you can't really say much about it until 5 to 7 years have passed, because within that time frame there's a lot of luck involved in luck determines most of the short term returns in these slow moving strategies. And by luck, I mean, it's at the end of the day, it's a trend following strategy. So all trend following strategies suffer from this problem of head fakes. So the index looks like it is going somewhere, and then you put on the trade, and then suddenly it reverses. This sort of whiplash keeps happening in trend strategies, and ultimately the reason why these things work is because your losses are small. But when it finally ends up riding a trend, you end up being exposed to the right tail. So you're basically chopping off the left tail, which is like steep losses, and being exposed to the positive drift in the markets. And that's where I feel our version that goes long momentum ETFs is probably a better incarnation of this strategy. And the second twist we have done is basically saying that instead of taking just a 12-month return, which seems like you're kind of depending on just one data point, right? Like 12-month returns is just one data point. And what might have happened is in between there may have been some earth-shattering moves, which just looking at the 12-month return you may not be able to catch. So what we've done is we've taken the most recent 6 to 12-month returns and averaged them. So that is basically the second version of it. So technically it is still dual momentum as described in the original sort of strategy paper. It's still looking at a fairly long look back window, but at the same time, it is trying to strike a compromise, saying, let's see if we can smooth things out a little bit instead of being 100% true to it. So both strategies are, you should expect sort of similar returns in the short term, but at least our back test shows that the drawdowns are lower when you take the average. So when you cut down your drawdowns, you end up with higher returns, because you're not starting from minus 30%. You may be starting from minus 20, so that the 10% that you save during your drawdowns accumulates over a period of time. So I think those are the two twists we have made to the strategy. And you can subscribe to those signals, and we'll send you an email whenever there are changes. And the funny thing is, right now they are long two different ETFs. So it's not that they are sending out the same signal. One is long world ex-US, and primarily because of Japanese and European stocks kind of picking up, and the other one is still long US.
So like, how does that work? Because normally you have only one ETF, right?
No, I'm talking about two different strategies. So
Okay.
we have Global Equities Momentum 1 and Global Equities
One and
Momentum 2. So, uh, the Global Equities Momentum 2 is what looks at the average returns.
right. Okay. Okay. Right.
So,
And do you like the strategies, Sham?
uh, personally, no, not a big fan, because I feel it's a very specific uh, incarnation of a broader sort of tactical allocation strategy. So why should we look only at US and DM stocks and only US bonds, right? If you think about it, there are about six or seven major asset classes, right? So you have your US stocks, you have your US bonds, you have your world stocks, developed market stocks and developed market bonds. Then you have your emerging market stocks. Then you have gold. Then you have your US real estate. Then you have your developed market real estate, right? So you have basically eight major asset classes. Why restrict your? I'll go only to these, right? Technically, you can basically take these eight asset classes and apply a trend filter on it, just like what dual momentum does, except it will be like octa momentum or whatever, right? So that would be the general case of this particular dual momentum strategy. So I feel um, it's kind of too well sort of data mined. So and if you're really worried about whether this is robust or not. And if you hold a gun to my head, I would say it's not all that robust. You should really be looking at the more general case, and and the general case also takes care of asset allocation for you. So, if you're looking at deploying a large amount of capital, then I would go with the general case and not with the dual momentum case. What do you think? Do you think this is robust, Kishan?
No, I mean, it's not. I think I might have told you this, but so we actually tested this out for Indian markets, and like I think you pointed out, so in India you don't have the option of global investing. I mean, you can do it. You can open an international account, but it's not. It's not seamless. It's not a great investing experience if because the time it takes you to move money from India to the trend might have shifted by the time you do all the jugglery, right? But you tested it out for Indian markets, and you tested it between mid caps and large caps, and investing in bonds. So you're basically trying to catch a trend, and the belief is mid caps do better in the mid to late stage of a bull run. So and the strategy did terrible. I mean, we tested it out, and it was way below the Nifty return, and you didn't really have even the safety of the safety of of a low drawdown. The drawdown was pretty sharp because what I don't like about the strategy is that you miss out. The best returns that you get in the market are during the recovery phase of a because those things tend to be high. Like I mean, you get a big spike. So those returns at the right from the bottom, from bottom to till it, because when the signal generates, that is a very sharp uptick, and you lose that. And when the market falls, it falls in a straight line, and so you lose out there because you are invested at the peak, and and you don't really exit at the very close to peak. You wait for it to fall below a certain threshold, and then you exit. So so you miss out on the best part of what you on the best part of the return, and you lose out in the worst, in the steepest fall, because you're still exposed there. So
Yeah.
those things are pretty sharp, so those things, market timing and and stuff, in here, you're basically trying to catch a mid range of the market, uh, and that is not always a high enough return for you to for you to justify doing this.
Yeah, so this is why when you ask me, I told you that this feels a bit too data mined, because so the problem you described is a problem of look back period, right? We touched upon it in the newsletter. So the thing is, when somebody says I'm doing a trend following strategy, you have to first ask him how did he nail down his look back, right? So if he says, okay, I'm using a 200-day SMA, right, to measure trend, then chances are he would have tried 1 day, 2 day, 3 day, 4 day, 5 day, and gone right up to 200. Probably passed it to 500, and then said, "Oh, this 200 looks good, so here you go."
Yeah, yeah, and while you're missing out the point that um, when you backtest strategies, right? There's a very old adage, like if a strategy works, if a strategy is sound, it should work in any market or any data point. Like it should give you enough, like it should show you that it's working or not with whatever random number that you try. I mean, obviously you can tweak it and see what is at what number, or at what look back period it works best with, um, but with any look back period, the strategy should have a sound result that makes you believe in it. But if you keep looking back and you keep changing between 3 months or 12 months, 24 months, it shows that you're actually really trying very hard to make this. I mean, you want to believe in it more than beyond what the data is telling you. Yeah. Like momentum, like a simple momentum, that we run, or that most people run, they differ by 12 months or 6 months or by 1 month. But most of the moment, whether you're doing it for 12 or 6 months, you'll see some amount of alpha, or some amount of favorable result that it generates. And if you take this strategy and if you apply it in a different market like Japan or something, it will also work in that market, because it's a sound, it makes sense from a rational perspective.
Yeah, absolutely. So see, the thing is, I don't have anything against trend following. Let me make that clear. In fact, I'm a big fan of trend following. But my biggest problem with trend following is that nailing down this look back period, like you mentioned, if it works in India, it should work in Japan. That doesn't work for trend following. So you have to tweak your look back periods, and for each market. So even in the US, right? So you will have one look back period for S&P 500. You'll have one look back period for Nasdaq, and so on. And anything outside of this, you'll see alpha decay fairly quickly. And that's what you noticed with this dual momentum when you applied it to India as well. So in India, trend changes fairly quickly. Like we are a very, we have paper hands here. It's not, it's not diamond hands. so
I want to see
like a complete panic. We just sell everything and put it in FD, or we are like so bullish that we are like, yeah, we're going to buy everything. So we never seem to have like this permanent capital invested in equity. So our trends are very short.
I think in India, everyone is a market timer.
Yeah. So what happens is, if you can't use like a 12-month look back period in India, that's why it probably did not work. And also the second problem is when you look at the historical data set, right, between US and Europe, they have basically not been that tightly coupled. Right, there was still a period not too long ago when Europe all had different currencies and different central banks and different everything. So if you pick up a book about the 1987 crash, or or older books, they talk about Deutsche Marks, they talk about the bunds and all that stuff. So the thing is, like still very recently, they were completely uncoupled markets. So when you do a back test, it'll work beautifully when you're trying to flip between them, because like even from a asset allocation point of view, when US is outperforming, Europe will be lagging, and when and they switch roles. But what has happened after the world financial crisis is that US figured out how to stimulate. Europe was stuck in hard money, and even now, they are saying, after this Corona thing is done, they want to go back to their debt breaks and everything. So,
austerity.
Yeah, austerity nonsense. Even UK did the same thing, after the financial crisis. So what has happened is, they just took the wind out of the sails of their own economy, right? So you had China willing to take their stupid paper money and give them goods, but they didn't want to do that. So but I think the US figured it out. So their entire Corona I think stimulus was 1 trillion, right? And then they have another 2 trillion coming down the pipe for infrastructure, and they already have some 6 trillion lined up for some other package. So so that their economy is like 20 trillion, right? So when you're pumping more than 5% of the economy in just cash, just pump it into the economy, right? So that's going to move things. So what you're seeing,
Sham, what do you think? Sham, because you're talking about economy and stimulus and stuff like that. The one area of of asset class which has done really well in the last year has been commodities. But have you seen any data or any result where people use global equities momentum? With the commodity set.
Not really, because you can't really invest in commodities. You're basically trading commodity futures. So,
but in ETFs,
yeah, but underneath they're trading commodity futures, right? So they don't hold physical commodity. It is not like the gold ETFs out there that actually hold the gold ETF. They're just trading futures, because there's no such thing as buying lumber and keeping it in a warehouse and launching an ETF on top of it. Most of these commodities are perishable, right? So all your wheat, corn, and everything. So you trade futures on them, and the problem with futures is the roll, right? So every expiry, you need to sell your current futures and buy the next one, and there is a roll yield, and you pay that yield to the market, right? So what happens there is, it's a guaranteed money loser. So unless commodities are really spiking, you really should not buy a commodity ETF. But that does not apply to gold, though. So the GLD ETF, they say they have the gold stored in vaults in London, and they have said it. So, and they've been audited and all that. I don't want to go down this conspiracy kind of rabbit hole and all that. So it's backed by real gold. So so people have tried with gold as this thing, but the problem is gold more or less is dependent on the dollar. I would say dollar credit cycle, right? So it does well, when there is a moment of panic, and when money is very free in the US, and people are worried about inflation. But but right now, the way things stand, the go-to asset during panic remains US bills, treasury bills, right? So even there, we see that historical correlations have broken down. So it may or may not come back. I don't know. So when you try to do this sort of back test, they will look good, right? You will see that when you add all these, this gold and equities together, they might look good. But at least recently they have not really delivered on that. So once again, I'm not a big fan of commodities in general, because it has always been at the back of my mind that technology is the biggest deflator. And if you look at what happened during the corona crisis and even now, right? So there's a weekend curfew in Bangalore. All businesses are shut and you're not supposed to go out. So, but they allow people to go out in the mornings for a walk. So I take that opportunity and I go out. And when there is when things were normal, right? Um, there was so much traffic around parks and everything. People going here and there with their motorcycles and mopeds and all that. But now there's a lockdown, and apart from some milk delivery trucks, you don't see anybody on the road. So what does that tell you? So does that mean that all the traffic that used to occur before was completely spurious? Like those people had they're just like going out around driving, hanging out, or was it actually essential? Right. So this whole Corona thing has drawn a sharp line between all the essential traveling and essential stuff that you used to do versus the fluff. And, and tech has kind of filled the gap. So earlier, if somebody would ask you to come and meet him or her in a cafe, right? Now you would probably just do a Zoom or a Hangout or whatever, right? Um, so tech has basically deflated the demand for commodities all over. And whatever spike that you're seeing in commodities is, in my opinion, it's a supply shock. It is not driven by driven by increasing demand way above its trend line, right? So I think demand just snapped back or is snapping back to its pre-corona trend line. And during the corona crisis, everything got shut down and people got laid off in in these commodity producing sectors, and now they're having a tough time catching up, so prices spiked. So once all these things come back on steam, you'll again see it go back to its previous trend line. So it's just an undershoot and a massive overshoot, and then back to where it was.
This is exactly what I think the US Fed believes.
Yeah, I mean, I'm with them. Like I've read the report, so I'm convinced. So yeah, so I don't believe in that commodities will ever be a big thing, a big deal. You're just digging up dirt and selling it. So there is a certain equilibrium price, but that's about it.
Yeah. So no super cycle.
Yeah, no super cycle. And look, even in 2005, by the time they said super cycle, the cycle was over. Right? That marked the peak, actually. So I think it was Goldman Sachs or someone who was going about with research report saying super cycle, and within 6 months everything collapsed. So yeah. I don't know. So I'm not a big believer in all this stuff, and in a way that should not prevent you from making money off it. So I think I recently tweeted out our free float all stars, right? We have that on subscription here. So it what 3x'd Adani Enterprises, right? It bought Adani Enterprises at some $300, and it 4x'd. I don't know, something like that, right? So it's all during the recent hullabaloo about some account, some nonsense. But the thing is, whether you believed in Adani or whether you believed in that bullshit, or whether it's a commodity super cycle, it doesn't matter. Ride the trend, manage your risk, you will make money. So people keep yelling at each other saying, no, this is bad, this is good.
But you need to know what you're doing also. Yeah. I remember when oil went negative, people called me up and asked me whether they should buy oil. And, I mean, it was very hard explaining to people that, you'll definitely lose money. Like, like people who have no idea of how to trade wanted to go buy oil barrels and then, store it somewhere. I'm like, you don't even know how to do. I mean, I mean, to do something like that requires a lot of knowledge, a lot of contacts, and a lot of this thing. And and just explain that the role, because the present month was trading negative, but the next month was trading like $20, in the positive. And just explaining that was hard,
Yeah.
So, like, if you like, and you might have some short cap, like small cap stock with no volume, no liquidity, and it might go up 3x. But the moment you try to sell it, it will all fall down.
Yeah, small caps, man. I mean, sometimes I feel sorry for all these guys chasing that dream. Like,
Yeah, I mean,
what if you had bought Amazon when it was $10? It was a small cap back then, and now it is like 20,000x. Dude, stop, right?
Yeah, but the people forget that most small cap stocks in the entire history have remained small cap.
Yeah.
I mean,
Yeah.
they all have some 30-40 year history, I mean, and they managed to survive, but barely, and the worst is stock which trade at like 1 rupee or 1 rupee 50 paisa or something, and people try to like, I know people who are trying to do that for Reliance. I mean, like ADAG group stocks, because someone was trading at some 6-7 rupees or so, and trying to believe that some recovery will make it triple or go 4 times. Yeah, so
I don't know, man. So the thing is, what I've realized is, you cannot really teach people who already believe in something, right? They'll just hate you for it. So, the best thing you can do is, kind of accept that there'll always be people who will have a different idea about what life is, and you move on from there, right? You can't really change somebody's beliefs, because I still have, I still come across people, and most of them, have ended up being long time friends who believe in the fad of the season, right? So, at one point it is hydrogen powered, whatever, hydrogen power, right? Then, then it is some pot, then it's lithium, then electric vehicles, then SPACs, and Tesla. It's You point out, the ridiculousness of investing in all these things, and but the problem is this: you will always hear about a friend of a friend who has made killer money in some junk bullshit meme nonsense, right? It's always a friend of a friend, by the way. It's never your friend, right? So he will be like, dude, this guy, right? He bought this whatever out of the money calls, and he tripled his money, right? Um, so what happens is, when you talk about systematic investing, and you talk about algos, and talk about factors, all you have is your historical track record, which is like, okay, 25% in a good year, and you have these drawdowns. So when you show this reality of it, that's not a good selling point to them, at least. So they're looking at this reality, and they're thinking about or fantasizing about a vastly different future. So those things don't reconcile with each other, right? So so there's always going to be a road not taken. So your buddies who want to buy oil by the barrel, right? I'm pretty sure they're still sitting there and thinking, what if I had done that, right? So you're always going to have those situations, and you can't really do much about it. So anyway, coming back to Global Equities Momentum strategies and so on. So we have this running on freefloat.us. So do have a look. And it's worth knowing about, so that when somebody talks about dual momentum, you'll immediately know what it is and how it has been implemented, and so on. So do check it out, and if you have any questions, let us know. And we also have set up a discussion forum, and if you have any questions, you can go and either about free float or strategies or how to use a product or whatever, right? So you can go there and and ask questions. It's the link is on the newsletter as well. So with that, I think we can wrap up. Kishan, anything you want to say? Right.
No.
All right, cool. So we'll catch you guys again next week. So